Hey there, have you ever looked at a stock chart or currency exchange rate and thought, why is this thing moving every second? 1 second it's up, then it's down. Is it broken? Not at all. This is just how financial markets work. And behind those small constant changes is a huge world of traders, news, technology, and emotion. Let's start simple. Prices of stocks or currencies change because of supply and demand. That's it. If more people want to buy something, its price goes up. If more people want to sell it, the price drops. And guess what? People are buying and selling every single second, thousands of times all around the world. Now, think about Apple stock. There are millions of people trading it. Some use phone apps, others are giant firms using computers faster than anything you've ever seen. There's always someone offering to buy, which is the bid, and someone asking to sell, which is the ask. And when a bid meets an ask, the deal is done, and that new price becomes the official price. That's how it updates every second. In the US alone, the New York Stock Exchange and NASDAQ process over 100 billion trading messages every day. That's more than WhatsApp sends on New Year's Eve. It's not magic, it's just constant activity. But who's making all these moves? Not just regular folks like us. Most of it comes from big investors, hedge funds, banks, mutual funds, and even robots. Yep, computers called algorithms place trades automatically. They can read news, analyze numbers, and trade in less than a second. When the US Federal Reserve made a major interest rate announcement in March 2025, the S&P 500 jumped 1.3%, and most of that happened within 90 seconds. That wasn't you. That was Wall Street bots. So what about currency? Why does the dollar, euro, or yen change value every second too? Well, currency is just another market, just like stocks. The Forex market, or foreign exchange, is the biggest in the world. It runs 24 hours a day, Monday to Friday, and trades more than $7.5 trillion every single day. Currency prices reflect what people think about a country's economy. If the US economy looks strong, that means good jobs, numbers, strong GDP, and the dollar gets more valuable. If a country is struggling, like having inflation or a political crisis, their currency might weaken. That's why the Japanese yen dropped in April 2025, after inflation hit 3.2%. People thought the Bank of Japan might loosen its policy. News changes prices too. Sometimes good news makes investors buy fast. Sometimes bad news makes them sell even faster. But it's not just news, it's feelings too. Fear and greed are powerful. If a stock is rising fast, people jump in because they're scared of missing out. If bad news hits, everyone rushes to sell, even if they don't fully understand what's happening. Want a real example? In Q1 2025, Nvidia reported strong AI chip sales, and boom, the stock surged. Everyone wanted a piece. But when Tesla's Q1 delivery numbers came in 4% lower than expected, its stock dropped 7% in one day. Why? Because investors quickly changed their opinion about the company's future. Also, if you're enjoying the video so far, make sure to subscribe and ring the bell so you don't miss the next one. Now, let's get back to it. Another reason prices move constantly is something called liquidity. This just means how easy it is to buy or sell something. Big stocks like Apple or Microsoft have lots of buyers and sellers. That means even if thousands of people trade them, the price only changes a little each time. But small stocks or currencies from weaker countries, they don't have many traders. So if just a few people buy or sell, the price can jump or fall a lot, like flipping a small boat versus moving a cruise ship. There's also something called price discovery. That's the process of finding the right price based on new information. Let's say there's a surprise election, or a company reveals bad earnings, or the government announces new taxes. All this info affects what investors think a stock or currency is worth. So the price updates, sometimes within seconds. Big global events shake prices too. In February 2025, when Russia paused gas supplies to Europe again due to a pipeline dispute, the euro dropped 1.5% in just an hour. At the same time, oil company stocks shot up. These price changes don't wait for the evening news. They happen live at the moment. Traders also look for tiny price gaps between places. It's called arbitrage. Let's say gold is $2,350 an ounce in London, but $2,352 in New York. A smart trader buys it cheaper in London and sells it for more in New York, using super-fast computers. This keeps prices in sync across the world, but it also means prices update constantly. And then there's all the chart reading. Some traders don't even care about news. They look at patterns. If a stock breaks above or below a certain line on a chart, that can trigger thousands of automatic trades. It's like a domino effect. One signal leads to hundreds of trades. But it's not just random. Traders know when to expect big changes. They mark their calendars. For example, when the US unemployment rate fell to 3.5% in May 2025, which was lower than expected, the dollar instantly went up. Why? Because it meant the economy was strong and the Federal Reserve might keep interest rates high. That single number moved currency and bond markets in seconds. Now, let's talk about AI. Yep, artificial intelligence is also making trades now. In 2025, major hedge funds and banks use AI to read news, social media, company filings, even Reddit threads, to detect early signs of good or bad news. If an AI notices something negative about a stock before it becomes official, it can sell millions of dollars in seconds. It's like a robot scanning the internet 24/7, reacting before humans even notice. All this brings us back to the main idea. Prices change every second because people, computers, and entire institutions are reacting to the world in real time. A news article, a central bank speech, a tweet, a weather event, or even a rumor. Anything can trigger a chain reaction because the market is alive and it never stops moving. But here's the important part. You don't need to panic about these changes. Most of them are just noise. If you're a long-term investor, don't worry about second-by-second moves. But if you want to trade, you need to understand what's moving the market and stay up to date. So next time you see a price flash green or red, know that behind that tiny move are millions of decisions, thousands of trades, and an ocean of information, all happening in real time. And that's the beauty of the financial markets. If you like this breakdown, hit that like button and drop a comment below. Also tell us, what topic do you want next? Thanks for watching, and remember, every second counts.